On March 22, 2021, a Wall Street trading firm called Archegos Capital Management began selling assets. Not gradually, not strategically, desperately. Billions of dollars of stock being dumped into the market in a panic liquidation that would wipe out $20 billion of value in a single week. The banks on the other side of those trades, Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura, lost billions. Credit Suisse alone lost $5.5 billion. Nomura lost almost $3 billion. The total losses across the financial system exceeded $30 billion. The man at the center of it was Bill Hwang, a former hedge fund manager who had previously pleaded guilty to insider trading charges, been banned from managing public money, and been barred from trading in Hong Kong. A man who by any reasonable assessment should not have been able to borrow a dollar from a reputable bank. He had borrowed $160 billion. Stay with me, because the way Bill Hwang built a secret empire of $160 billion in stock positions after being convicted of insider trading, using instruments so complex that the banks lending him the money could not see what he was doing, is the story of how sophisticated financial regulation can be completely defeated by slightly more sophisticated financial instruments. Bill Hwang had made his name working for Julian Robertson at Tiger Management, one of the most successful hedge funds in history. When Robertson closed his fund, Hwang went out on his own and ran a hedge fund called Tiger Asia. Tiger Asia was enormously successful until 2012, when Hwang pleaded guilty to wire fraud and agreed to pay $44 million to settle insider trading charges. Tiger Asia was shut down. A lesser man would have retired. Bill Hwang converted his fund into a family office called Archegos Capital Management. A family office manages the personal wealth of a single family, rather than outside investors. Family offices are subject to significantly less regulatory oversight than traditional hedge funds, because they are not managing public money. Archegos began trading, but it was not trading in the conventional sense. Hwang used financial instruments called total return swaps to build his positions. In a total return swap, a bank buys shares on your behalf, and you agree to pay the bank any losses and receive any gains, as if you owned the shares directly, without actually owning the shares. The bank holds the shares, you hold the economic exposure. The advantage of this structure from Hwang's perspective was twofold. First, he could build enormous positions without his ownership appearing in public filings, because technically the banks owned the shares. Second, he could use leverage, borrowed money, to amplify his positions far beyond what his actual capital would have supported. Hwang took both of these advantages to extremes that should have been impossible. He built positions in a small number of stocks, Viacom, CBS, Discovery, Chinese technology companies, that represented an extraordinary concentration of risk. He used leverage ratios that amplified his gains and losses dramatically. And because each bank could only see its own relationship with Hwang and not his total positions across all banks, nobody understood the full scale of what he had built. At its peak, Archegos had approximately $36 billion in actual capital and had used that capital to control positions worth approximately $160 billion. Every 1% move in his concentrated stock positions generated or destroyed roughly $1.6 billion of value. In March 2021, Viacom CBS announced a stock offering that caused its share price to fall. Hwang's positions began losing value. The banks that had lent him money began demanding additional collateral. Hwang could not meet the demands. The banks began liquidating the positions to recover their loans. The liquidation was so large relative to the normal trading volume of the stocks involved that it crashed the prices of those stocks, which triggered more liquidation, which crashed prices further. The spiral consumed $30 billion of value in days. Hwang was indicted in April 2022 on federal charges of racketeering, fraud, and market manipulation. He was convicted in July 2024 on all counts. His sentencing is pending. The banks that lost billions had conducted due diligence on Hwang before lending to him. They knew about his insider trading conviction. They chose to lend to him anyway because his trading was profitable for them, and because their risk management systems could not see his total exposure across multiple banks. Bill Hwang built a $160 billion empire after a fraud conviction. He lost it in 2 days, and the banks that enabled it lost $30 billion they could not get back. If you believe the public deserves to know where the money actually goes, subscribe. Every week, we cover the frauds, the scandals, and the financial crimes the system wants you to forget.